Good afternoon, everyone, and thank you for joining us for our Hyperion Fund investor webinar. I am Tyler Resch, managing partner at Le Mans Trading LLC, which manages the Hyperion Fund. Well, we've had an eventful year so far. We're going to focus on the second and third quarter of the year on this call, two very different quarters back to back, which really does highlight what we try to do at Hyperion, which is ultimately to stay disciplined, take the opportunities the market gives us, and protect capital regardless of what the trading day brings. Hyperion's priority is, and always will be, capital preservation and steady growth. We employ a very disciplined approach, which really prioritizes risk management and generally small but consistent gains. Sometimes, like the third quarter of this year, that does require more patience than we'd like, and this recent period has been quite unprecedented. That word is often overused, and I want to defend it for a second. We published some research earlier this month from one of the traders on our in the long vol portfolio. Mike Kaminsky looked back at the last 35 years of S&P data to show us that this is only the third time since 1990 that the S&P has risen 30% or more without a 3% pullback. It happened in 1994, it happened in 2016, and it just happened in the third quarter of 2025. In 2025, it happened in half the time of those other two instances. So although not unprecedented necessarily, it's very, very rare to rise this far, this fast, and not see a pullback somewhere in the interim. October, however, even if only for a moment, reminded us that volatility is still very much here, and the risks underlying the market are very real. We generate alpha using short-term direction, or sometimes the lack thereof, on the S&P 500. Or primarily the S&P 500. We do well in bear markets, sideways markets, most bull markets like 2023 and 2024, but we do naturally underperform in melt-up environments like this last quarter. Before I dive any deeper into market behavior and how we responded, I'd like to introduce a key new addition to our team. I'm very pleased to introduce to everybody to Mark Adams, who recently joined as Hyperion Fund's full-time risk manager. Mark brings extensive experience in options risk, quantitative modeling, and portfolio oversight, and has worked closely with us for over a decade. Mark, welcome to your first Hyperion Fund webinar.
Great. Thanks, Tyler. I appreciate the opportunity to kind of meet everyone. Everyone can put a name to the face, and I'm happy to join. I do think you have a wonderful product here. I know I've been associated with it for a while now, and getting to know the inner workings, it makes me even more optimistic about what is going on at Hyperion. I think it's a great fund, and more people should know about it.
Well, thank you, Mark. We're very excited to have you. And I do want to point out, I think when people hear risk manager, they think of constricting activity. So you're constricting what we do. We look at risk manager a little bit different. So yes, you do help us identify concentrations or areas of vulnerability in the portfolio, but you also help us understand where we're underallocated and where we can deploy risk in a thoughtful way. So this is a role that kind of has two sides to it. Before we talk more about that, Mark, to put you on the spot a little bit, tell us a little bit about your prior experience and kind of what you bring to the team here at Le Mans.
Sure. So my background, I've been trading options, since 2002. Anything under the sun, mostly S&P futures options, but you go back to the age of Dow and the Russell, OEX even, so my gray hair and thinning, hairline will probably belie my age a little bit, but, it's that experience that I've kind of, it's the whole Malcolm Gladwell, stare at the screen for long enough and you kind of get a good feel of it, the whole 10,000 hours. So just staring at a screen, getting a feel for, what's going on, and then seeing where the puck might be going. I think that's one thing that like you say, taking a different approach to risk management. It's not just reacting to what's going on, it's anticipating as well. So when you start to see the cracks under the surface start to expand, I mean, this is perfect timing for this call because exactly what's going on. I mean, today's a great day to start talking about regional banks, et cetera, et cetera. But it's that type of reading the tea leaves a little more than just reacting to what is the portfolio delta now. Well, what situation would cause the portfolio delta to be somewhere we don't want to be? Where would we have gamma exposure if X, Y, or Z happen? To anticipate kind of moves that you don't want to see, ensuring portfolios are set up for that. And then in this instance, to see how the managers all work together, not necessarily coordinated, but how you and I can help steer the, allocation across and, tightening risk where we need to, obviously, but being a kind of ahead of the curve as opposed to reactive, I think is a very key thing. And I could, take over the whole call and talk about, the last, 20 years where I've seen risk and kind of change portfolios around it, but it's using various sources, be it Twitter, be it just, looking at indicating, or Twitter or X now, looking at what's going on underneath the surface, not just the VIX, but the volatility of VIX, the VVIX, looking at the slope of the futures curve or the VIX futures curve to see how that's pricing. It's things like those that are, after trading this for long enough, you kind of see where things might be going and where the market may show its hand a little early. So that's kind of one of the aspects I think I can bring to the table that that some managers may just say, we don't look at that or don't think about it, but you know what, it's important stuff nonetheless.
I couldn't agree more, and I appreciate the overview, Mark. I've always thought of, especially the S&P 500 options chain, as having its own personality that doesn't necessarily coincide with what the underlying market is doing. And having spent so much time there, you get to see, or you start to pick out the unique responses a little bit more closely, right? It's not just market does X, option market does Y, and the VIX does, Z. It's different and it's always changing. And it does take kind of a close relationship with it that has to be built over years, if not decades. Would you agree with that?
Very much so. Yeah, I think that's like I said, the gray hair and staring at a screen and looking at what Bloomberg is telling you at 2 a.m. sometimes is part of the deal. You have to markets are essentially now they're not always open, but you're always getting inputs. Over the
Yeah, right.
weekend you're seeing, the administration did this or XYZ person said that, but being able to you're not going to catch all the breaks every time ever correctly, but seeing I would rather be a little conservative in that sense to say, hey, this is something I've seen before. It's walks like a duck, smells like a duck. Maybe this could be a thing. I don't think this is going to be '08 or anything like that, but you know what? This could be an issue we should pay attention to. It's that type of, I don't want to call it intuition because you're using evidence to build a case for it, but you're looking at
Right.
certain indicators that may not be on the radar. And, how many times have we seen in history where people will say, oh, this event came out of left field? Well, no, it didn't. It was, the market was telling us for 2 weeks prior to that. If you look at, bid-ask spreads maybe widening out, price of deep out of the monies may be increasing, volatility, curve may be changing. There's always a number of instances or indicators that may be flashing a yellow light. You just have to listen to them.
Well, you say, or I think you tried to dismiss your intuition a little bit. I understand that there are concrete metrics that you look at or indicators that you look for, but the intuition is in translating it, right? What does it all mean when put together? And I think that's where the experience comes through, the intuition, and as is following your gut, right?
Mhm.
Um, all right, we're going to jump right into performance. Like I said, we'll focus on Q2 and Q3. Q1 this year, we performed very well, and we've had a webinar to discuss that. We're happy to share it. But we're going to focus on two periods, one where it's very conducive to what we do, and one where it's very challenging for what we do. I've summed up the 2 quarters this way. Q2, volatility provided opportunity, broad participation across strategies, strong results. Q3, relentless equity rally, compressed volatility, narrow opportunity set, capital preserved. So again, focusing on the second quarter, as I said, generally elevated but orderly volatility, somewhere in the mid-teens throughout the month or throughout the quarter, which created consistent opportunities across our portfolio. There was a macro uncertainty belying the market, started in April and continues to this day, although has been ignored for the past several months. The Fed, inflation, tariffs, range-bound equities, that all played to our strengths in the second quarter. The result was a strong Q2 with steady gains and pretty limited drawdowns. Mark, during that second quarter, maybe especially April into May, coming off of the bottom in April and then, starting that strong rally in May, how would you describe your approach to risk management when volatility is spiking and then crashing? As you said, metrics. What metrics matter most to you in those environments?
Right. In that one, specifically going back to April, I felt that weekend risk was very underpriced. That that's when the macro events were happening. When you were seeing over and over again, here's this major event and this is going to happen, an announcement will come, and here's a tariff that may or may not happen, and the markets were caught flat-footed by that. So that type of thing, by managing that risk specifically as a PM, I chose to specifically reduce risk over weekends because you weren't properly compensated for it. So things like that are seeing how the market actually is pricing specific risks. So a lot of times, come Friday afternoon, they'll essentially take the premium out of options and then say, all right, it's like the weekend doesn't exist. That was happening way too often back then. And I think taking things like that into account, reducing portfolio risk over weekends, and then also just widening out positions, reduce risk first. And then any new opportunities must be really wide, when I say wide, essentially a wide, moat around that or around your risk metrics to make sure, because you couldn't you really foretell what the next announcement was going to be. It was either going to be we're going to triple tariffs or we're going to take them down to zero or based on whatever. It was a little too erratic for my preferences, and you saw it in volatility. You saw it in the VVIX. Things were going very randomly for way too long. So first order of business, cut positions. Second order of
Mhm.
positions, new positions. All right, second order of operations is any new position needs to be relatively conservative. But, yes, could the portfolio have made 2, 3x what it made? Sure. But it could also have lost, a lot more, or it could have had losses had those risks not been properly cared for.
Yeah, it's interesting how that happens, where the weekend risk all of a sudden goes away. It's as far back as I can remember, 2018, the pandemic, 2020. I believe April this year. It started Thursday, continued Friday. Sunday was where the really broke, and then Sunday night into Monday was the climax of that move. Yet the weekend risk is kind of ignored. It
Right.
also seemed like for a while there was an intention to drop news on a Sunday evening, and it's
Yes.
just like
Yeah. Yep.
it couldn't be avoided. Um,
I mean,
I
like
do
we
want to
saw
point out
last
as
week. Oh, sorry, Tyler, real quick. Like we saw last week, at 3:50 p.m. Central Time, Trump comes out and says, "Oh, here's some negative news. We're gonna be very aggressive towards China." I mean, whether that's by design or not, who knows? But yeah, there seems to be a lot of that, in the weekends, kind of situations, unfortunately.
For sure. I'm looking forward to talking about October because that's the fun stuff to talk about. First, we're going to talk about these 2 quarters here, and I do want to point out, because we talk a lot about downside capture and the ability to be long vol in the portfolio. April here was a month that ultimately finished relatively unchanged, right? We bottomed somewhere in the middle of the month and then closed pretty flat on the month for the month of April. I'm talking about the S&P 500. When we have intra-month volatility like that, we can capture the downside movement, realize that profit, let the market recover, and not give it all back. And that's, we'll see where today closes, but that's part of what's happening here in October. We had that move that you mentioned last Friday. Markets somewhat recovered, going into today. We've captured most of that profit early on, and it's been realized and banked. Um, so I don't want to give anyone the impression that we're rooting for the world to collapse and that's where we really clean up. We need a little bit of two-way action to be able
Love
to
it.
generate a return. Um, there's probably not a lot else to talk about Q2. April was the big month. You see in June, that's where the equity rally really took off and our returns became more muted. Um, Looking at Q3 specifically, as mentioned before, a near uninterrupted melt up with realized vol generally under 7% for most of the month or most of the quarter. Opportunity for new market neutral trades either was very, very difficult to come by or all but disappeared as implied vol just collapsed. The long vol positions that we always maintain in the portfolio, because you cannot time a market collapse, they naturally bled as the market stayed one directional. The other challenge I do want to point out, two things I want to point out. In September, we had the Fed meeting. The Fed meeting, I can't think of another forecasted volatility event that elevated the option market for that long. It felt like about a 6-week period going into Jackson Hole the entire option chain was elevated, and therefore all of those long vol positions that we put on and we maintain were more expensive. And then the Fed announcement came out, the market had a bullish reaction, and all those positions lost more than they typically would in a typical bull market. So that was a challenge. That's why December was weak. The reason August was less weak and more profitable for us was, again, just a 2-day event to start the month. The market crashed to start August, and then ultimately recovered and had a very bullish month. But we were able to, capture that gain early August, and still maintain a good month. Mark, tell us a little bit about what the option chain looked like. You can talk about going into the Fed meeting or just any period in that third quarter where I think it was a very challenging market. But what were you
So
seeing?
yeah, September was really interesting because the Fed had been widely anticipated to cut. Okay, great, fine. But there was so much event fall tied into that single day, like you mentioned. But it's really interesting the way event fall works because it's a known unknown. Even though we knew what was gonna, we were pretty sure we knew it was gonna happen. We were pretty sure the Fed was gonna cut. Was it gonna be 50? Probably not. Was it gonna be 25? Yeah, it's like here's this chance. There's like a 2 or 3% chance of 50. That would have been silly for them to do, I think. But getting the way markets were pricing, sometimes, I mean, it reminds me, I'll date myself. After Brexit, Brexit was a big shock. Everyone was, taken aback. We
Sure.
didn't know what to do. There was a French election a few months after that. Well, the French polling is very different than British polling, apparently. It's much more accurate for whatever reason. Well, no need to go into the intricacies there. But what the difference was, markets put so much event vol into this one thing that it was option prices for that Friday over the weekend because they thought another Brexit was going to happen. So markets tend to be, I don't want to say manic, but they kind of obsess about things that way. It's like, oh, well, here's this Fed. Are they going to cut? And they're cutting because everything's terrible, all this stuff. No, it's just they broadcast this, so they have to follow through with it. So I think in that case, like you saw with your long vol positions, they were buying expensive volatility, and then as the event happened, volatility fell off a cliff. So that's tough. That's a tough situation because, but what is the chance that they don't cut? That they came in and said, you know what, we're not gonna do it. Then you have that volatility probably still wouldn't spike, but the market would move quite a bit because there's so much vol tied into that. So at the end of the day, it was I think I won't say artificial, but unfortunately sometimes a manufactured volatility event that really didn't turn into anything. Very
Well,
different
and
than
you
October.
also, I mean, they could have cut, and the market's priced in the quarter basis point cut, and the market collapses because they only cut 25 basis points. So for a fund like ours that does protect that downside, because we want to make money when their equity portfolio is underperforming or losing, we don't really have a choice but to put those positions on. And I was surprised that there wasn't more volatility, but I guess when everyone's hedged, the market doesn't go down, right? And that's
Yep.
that's
Yep.
kind of what we had.
When the event is happening, it's like it takes events like last week where, something just comes out of the blue where, oh my gosh, people are caught flat-footed. Friday afternoon, Friday midday, whatever you're gonna call it. Oh my gosh, this is new news. I'm not prepared. Then you see vol expands, option prices pretty, today, good example, pretty strong reversal, about 100 points so far, S&P reversal intraday, and that's caused volatility to come up. I mean, call it regional banks, call it whatever you want to go into what the specific reason for it. Sometimes the market doesn't need a reason. It's just like, hey, we reversed and now people are freaking out. Why? Probably because there's, are obviously are already some flashbacks to last week. People freaking out into a Friday. So we'll see if it continues.
Yeah, I do get the question, coming out of a third quarter like that, where, although we were certainly positive and didn't lose money, they're like, what changes have you made following a third quarter? I think back to August of 2024, where we had a drawdown, and there were changes that were made in the aftermath of that, and that was a drawdown that we were not okay with. This current environment, where we have this balancing act between market neutral and long vol, and it's a relatively delicate balance at times. It still keeps us positive, 9 out of 10 months. And there's just periods like this where you're going to underperform, and it's part of the process. It's harder to say these things if they persist for, a year, right? But here we are in October, vol is emerging, and historically after periods like like Q3, volatility and dispersion tend to reemerge. thankfully it's happening now, and we're having a very good October. But it's probably a good point to transition to. Well, before I transition to October, I just want to. This slide really helps illustrate what these are 6 month periods, but what these two 6 month periods look like. So that light blue line is the last 6 months. The light gray line is the prior 6 months, so October 2024 to March of 2025. And really what this is showing you, so if you look at the light gray line, you see, these are 1 to 3% up and down months in the S&P. So very typical trading, still a bullish environment. We had great returns throughout this period. There's two-way trading. It's back and forth. There's some intra-month volatility. You still have significant bullish months. You have some drawdowns. Transition to the last 6 months, coming out of April of 2025, this light blue line or teal line, you see the slope of the angle of this run, right? It's extreme compared to that prior 6 months. This is where opportunities disappear. So I was looking at the option chain, with Mark and our other traders throughout this period. Mark, I swear, if you go 50 basis points out of the money on a position that expires anytime in the next 2 weeks, there was just no liquidity there, or they were pricing it at 5 cents.
Exactly.
And darn well that is more risk than 5 cents. So you just can't put the trade on.
Mhm.
What do you do in an environment like that?
Yeah, I mean, first, one comment about this chart. It is, since it's a monthly chart, you're kind of hiding the real volatility in April because that
Yes.
was a really nasty down and up. So the fact that Hyperion had a good month in light of that nasty reversal, down then straight up, that I think that can't be understated. But getting to the point of I call it the transition from low to high volatility. One of the things I've been steadfast about in my career, as soon as you start taking on a lot more risk to maintain a level of return as an option trader, that's when you're opening the door for disaster. It's a really easy way to reach for those, oh, well, I sold this for 60 cents. Well, it was, let's say 5% of the money. Now it's 3.5, and maybe tomorrow it's 3. You creep that too much. That's a great way to just get, I don't want to say, put out on a stretcher, but not to be that extreme, but you can really incur losses. I mean, I've seen it before, I've learned from trading lessons. I could go back to February 27th, 2007. I can specifically remember the day where it was like, I won't bore you with all the details, too many of these old stories, but essentially it was that kind of thing. It's like I learned a lesson really early in the, hey, wait a minute, don't stretch for better premium in a tight environment like that. What you do is you find the opportunities. So there are going to be times where, like around the Fed, volatility is expanded a little bit. Yeah, there's a lot of volatility, but yeah, you pick and choose your example, or your areas where you can kind of harvest some volatility, both for long or shorts, depending on which way you want to approach it. But I think that's the play in lower volatility environments that way. As soon as you start reaching for more risk, is a great time to get smacked, and it can hurt. You want to avoid it.
It's a great way to put that. I don't know if I really had thought about it in that context, but maintaining a rate of return, but increasing risk to do so,
Yeah.
right? So the market's changing, and rather than it's accept it and sit on your hands, you add more risk just to generate
And
the
not even
same
sit on your
return.
hands. You just say, hey, look, instead of, my normal month may have been 70 bips. This month will be 42 or
You're
35,
right.
whatever. Be like, I'm okay with that. And my investors, because I've told them, here's when I do well and here's where I do poorly. They know that going in. They say, all right, I'm okay with this. We made money, not as much as I'd like to. My Nvidia really did great this quarter. Okay, great. But when that Nvidia is off 7% a day because XYZ happens, and this investment does a lot better, and then there you go. That's why you have both. I'm not saying no single fund should be 100% of your portfolio, obviously. So each has its own purpose, I think.
I couldn't agree more. That does kind of nicely lead us right into October. So I obviously you can submit questions. Any questions that you have about the last 2 quarters, we'll cover at the end, or happy to do an individual call with anybody that would like. Um, Moving into October. So thankfully, we don't have to talk about volatility returning and keep our fingers crossed and hope that it does. It's here, very much so. And that last Friday was pretty extreme. I do just want to talk real quickly about that first week of the month. This is, as you can see in this top chart, we're kind of bouncing between these two support and resistance level. This is a two-way trade for us. So this is not one-sided. This October 2nd through October 10th is a very profitable period for us. We can put up a very nice, compelling return in this type of market environment. We were fortunate enough to have an October 10th event where the market really collapsed going into the close. It's very profitable for us, and we've managed to hang on to most of that profit. In fact, these last few days where you're seeing the intraday ranges really expand, they've been profitable days for us, although the market's finishing up, 20, 30 points the last couple of days. We made money both days. Um, Mark, October vol returns, because we had a pretty significant day, and I think it was relatively interesting for a number of reasons. One that really stood out to me was the tweet caused a gap of about 120 points based on my chart. So the market did not trade for 120 points and then traded for the next 100 points down. That's pretty unusual.
Right.
May have very well happened to a smaller degree in April this year, but otherwise, I don't know that it's really happened since 2020, where you have a gap like that. And there are, like what many people might not understand. If you have a stop loss in the market and it gaps that far, your stop loss is going to get filled down here where the gap trades again. And that can be, there goes your risk management, right? So we don't use stop losses, we use options to mitigate our risk. But talk to us a little bit about how you approach a market like October differently than you did in September.
Sure. So, like we kind of saw, like you say, that Friday, things started coming unglued pretty early. So, one, you either hedge your positions prior to it, reduce them, or, depending on how your position coming in. That's when you start to see, I don't want to say, like random volatility, but these are kind of caused by decree. So if you look at it and say whatever your politics are, it is true that President Trump does impact markets through his statements both directions. We saw it. He said some things, then after hours, that's one thing the chart's not showing. We fell another 80 points on the S&P around a little before 4 o'clock, and we're like, what is going on here? And then we can have a 10-minute conversation about the crypto world that happened right around the same time. There are, talk about stop losses killing you. I mean, people were forced out because of leveraged positions, but there's a mess right there. But then you see, as quickly as it started, we gap up over 100 points on Monday, and we kind of have, okay, it's fine, don't worry about it. So it's a really, I don't want to say manufactured crisis, but it was very much well, did we need to react that poorly? Probably not. Do we need to, react that well on Monday? So I think part of that problem is that because we've had the September and August and everything before that, the market had just been drifting and fine. So when you get that first shot across the bow, oh my gosh, we're going to have another trade war, we're trying to again, here we go, this is going to happen. That's when, like we've talked earlier, people aren't hedged for that. People were not ready. So they scramble for hedges. So what do you do as a portfolio manager? I came in and I was already kind of pretty well positioned. I have built-in hedges to the positions I'm holding. So I didn't have to do a lot to button up things. But what I didn't do is add new positions, or add material new positions, I should say,
Yeah, right.
tweaked around the edges, things like that. But this type of volatility is, it's too random to say, oh, I'm going to anticipate that. You can't do that. But then, as quickly it gets unwound on Monday, people made or lost, a whole lot of money between those, the close on Friday and open on Monday, just because of, like we talked about, that weekend effect was underpriced. And I think that's still the case right now. So we're seeing it today. I bet you if we follow through a little bit tomorrow, weekend prices should start to climb back up because it'll be the second week in a row. We've seen that, and the market is retraining participants to now properly allocate, I guess risk buckets toward weekend risk.
It is funny to me after only 5-month period that the market needs to be retrained that there is risk underlying it. It was just April, right? We were down 17% at the low. Um, this chart below October, this green portion on the right side is basically just illustrating this rally from the low in April, and just how it's very one directional. And then you can see the stark difference between October's trading month to date. All we need again is this two-way volatility. Because we are a relatively static approach in terms of our methodology, and that long vol part is always on. we don't need to react to the market. We're positioned for for the outcomes that the market gives us. It just depends on whether or not we're realizing profit or cutting risk, but we're not doing a lot of alpha generating once the move has happened. We're actually we're harvesting it, we're realizing it. um I think that's good on October. What I guess as we go through, so we're now in the fourth quarter of the year, some of these tail risks are quite obvious, China, being a big one. You mentioned crypto. We're not going to talk about crypto here, but it seems like when there is this euphoria and then liquidation crash. I just saw an email today. Velocity Shares is putting out a 5x leveraged S&P ETF. It's very familiar, right? We've been through these euphoric stages. They always kind of end a similar way. I feel like this one will have fireworks because that's just kind of the environment we're in, right? Everything's extreme. What are some of the tail risks or headwinds that you think about going into the fourth quarter or going into 2026 even?
Right. I think the general unwind of complacency, we're already starting to see it. So once you have, the idea that everything's gonna be great and don't worry about those risks versus everything's gonna be terrible, everything should be, sold, every rally sold instead of dip bought. You think of it that way. So you're starting to see some, I don't want to say weird things under the surface, but you're seeing, the subprime auto issues, all of a sudden the regional banks across the board getting smacked here. It doesn't rhyme with 2008 because it's obviously it's a much better, I hate to ever bring that up as a comparison, but it's a little strange. Are these the first, cracks underneath the surface that we're starting to see? If we're going to see that, does China escalate? I think that's a pretty straightforward one, but I don't think it's in either of our best interests to really escalate problems. So I think cooler heads should prevail, but we've seen this
Yeah.
movie before. You go back to, 2018, it was, oh, we have a great meeting with China. Oh, it went terribly. We're raising, tariffs and blah, 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 blah. It's going to be constant problems there. So I think what you'll see is, based on that chart, you see like kind of the baseline level of VIX in that, call it, 16 to 18 range. I hope the baseline level of VIX is 20 to 25, where it just doesn't spend a lot of time in those mid-teens where we don't go back to those. So it's like more of a, hey, this is a, in that environment, I think that's where two-way trading is just golden. It's a wonderful
Yeah.
big wonderful thing to be able to do. We're not just buying and holding stuff. We're not just selling volatility, but what we are is as a fund, it's like, hey, we're taking advantage of these in some ways and taking advantage in other ways. And I think that's a very attractive thing that seems to be in the offing. I don't. It's fourth quarter can be call it the end of year after a long run up. People start looking one eye toward the exit. I've had a great year. I don't want to give this up. Will that be the dominant factor? Who knows? But it sure doesn't feel like it's off to a wonderful start here in the quarter.
That that meltdown in December 2024 going into the holiday week, it was very, very profitable for us. So although
Just some
um,
volatility. It's all you need. That's the answer.
yeah, and that chart that was showing the spike in the volatility, and kind of comparing it to the last time there was a tariff tantrum there in April, it is basically just to illustrate that this may very well be a volatile period that is just getting started, right? That's the VIX just bumped its head against 20, which is a little bit of a resistance line there, going back to a couple of points, even beyond this year. But this is, we put this slide up just because I think it's a powerful illustration of how we perform in dislocations or volatility expansions in the market. These are the down months in the S&P, so since we started the fund, and then our the right column is our corresponding return, which various degrees of green. Mark, I'm going to ask you one more question before we wrap up here, and I know you're new to the role with Hyperion Fund, but you're very familiar with us and what we do and how I built this portfolio, how I approach it, how I think about it. For our investors, from your perspective, what is it that you think, or why do you think that the edge that Hyperion Fund employs is persistent and can continue?
Really, at the end of the day, you're trading volatility. And volatility, whether it's low, whether it's high, you have experts that you've employed to take advantage of those situations. I can speak to certain aspects that I can trade around, but I see other portfolio managers that you have as well that take advantages of other types of volatility environments. If you kind of look at the kind of the everyone of kind of the wide swath of low to mid to high, not necessarily black swan type of vol, because that's tough to ever invest in and make money, but you cover all those bases. And that's, I think, the key and one of the most attractive features of what you're doing. And I can attest to the mid to mid high levels of volatility where I can do my best work. And that's a very, appealing thing to have a lot of those swaths, covered. So if, get to a low to a high volatility environment, some strategies may not do well, but others are going to pick up. So it's that kind of, it's not necessarily offsetting each other. They're complementary. And I think that's the key. You can go long futures in one account and short in another in your hedge, but you're never going to make any money. That doesn't make any sense. So you need to be able to have, hey, here's some things that I can take advantage of in this environment. And then when that changes, these will pick up. So you always have like a constant potential source of profitability across the entire portfolio. I think that's a very attractive thing.
I completely agree, and that balance, that somewhat, although it will result in a more muted return, is why the equity curve is smooth and to the upper right, is
Yep.
because there is a balance of, I don't necessarily want to say hedging strategies, but strategies that are more conducive to certain markets than others. And we always have something that should generate a return regardless of what the market is doing. So managing what the other strategies lose in that environment is really what the most important factor is.
Right.
Um, it's a bit of a balancing act, and there are times where it works out better than others, but it generally seems to be working. Um, so Mark, thank you again for joining us. I'm going to go into a little bit of a closing remark here, but before I do, I just wanted to thank you. Welcome to the team. You'll be seeing more of Mark on our webinars, and if you'd ever like to speak to Mark directly, just
Yep.
reach out to us. We'd be happy to set that up.
Great. Thanks so much, Tyler. Appreciate it.
Absolutely, Mark. To close out the call, we enter the fourth quarter here with a solid foundation. Risk is contained, capital is preserved. There's a strong lineup of strategies. Our portfolio is healthy. The market is normalizing a bit, and we do expect volatility ahead today, last week, this week is a great example. We're in good shape to finish out this year strong. I want to take a moment before we end to recognize the hard work of our team here at Le Mans. We were honored to receive an award last week from Hedge Week for the best multi-strategy fund under 1 billion. It also coincides with our 5-year anniversary of the public fund offering. We launched Hyperion in October of 2020. It's now October of 2025. So we're at our 5-year anniversary, and we're accepting an award from our peers in the industry, which is a nice pat on the back. So thank you to the Le Mans team, and more than anything, thank you to all of you for your continued confidence and partnership. We'll continue to be good stewards of your money, and look forward to speaking to you soon. Take care.